Good afternoon, good evening. My name's Jake Gronowski. I'm a founder and principal of 12 South Advisory. We're a fractional CFO and tax planning firm here in Nashville, Tennessee, assisting small businesses to find financial clarity within their numbers. So thanks for joining us today. We're doing our weekly Facebook Live today at 5 p.m. Central Time, going over ratio analysis in your company's financial statements. So yes, financial statements. I know everyone loves going through their financials monthly or quarterly, especially when you don't have a degree in accounting, I guess you could say. Oftentimes it can be daunting and overwhelming. So breaking it down into using, simple ratios is oftentimes your best bet. Let me pull up window here. So yeah, I've just got a sample income statement here, also called a P&L, profit and loss statement. Obviously, it starts with your revenues, and then cost of goods sold or cost of sales, whatever you want to call it, is always below revenue. Revenue minus cost of sales is going to get you your gross profit, and then from there, operating expenses, which involve things like overhead to classify it mainly. So like office salaries, C-suite salaries are going to be in your overhead, as well as insurance, vehicle, fuel, maintenance and expense, things like that. So yeah, revenues less cost of sales and operating expenses give you your operating income. And then obviously your net income is your bottom line. So yeah, gross profit margin is going to be, excuse me, we'll start over here with revenues, comparing the current year with the prior year. As you could see, let me blow this up a little bigger so you could see. Um, make sure I'm sharing the right screen here. Yep. So as you could see in this example, construction revenue increased by $2 million from the prior year to the current year. Um, Typically, you'd say, hey, that's great. Our business grew by 25%. But in some situations, that could be not all um, not all good, I guess. Not all stars and flying colors, but um, so yeah, in this situation, cost of sales also increased by 38% here, as you could see. So that's kind of something to look at. Op expenses as well increased by 26%. So in this particular example, costs are growing faster than revenue. So either pricing too low, you might want to look at your pricing, price things higher. Also, maybe incorporate job costing, which is what we've covered on a previous Facebook Live. Um, or maybe even operational inefficiency here. You might have too many people, working in the back office. Your headcount might be a best bet to maybe reduce the workforce, perhaps a few layoffs or cut ties with a few employees, unfortunately. Um, but yeah, in recap, growth is unhealthy in this particular scenario. So yeah, some good P&L ratios are going to be your gross profit margin up here, which is gross profit divided by net sales. So 30% is pretty decent. Um, I guess you could say, so gross profit divided by net sales. So gross profit down here, 3 million, just over $3 million divided by um, net sales, which is in this case, there's no sales allowances and returns. So it will be your net revenue right here. So that's how we got the 30%. Operating profit is going to be operating income divided by net sales. So $355,000 divided by your top line revenue here, $10 million. So a good operating profit margin is typically between 10 and 20%. So in this case, it's just a tad low. So it might be best for this company to kind of take a look at what they're spending their money on. Maybe renegotiate contracts with vendors. Their materials seem to have gone up in price here significantly. Also, maybe take a look at what these operating expenses down here, these guys in particular, have increased year over year by quite a bit. So that's this example. On to the next one. Uh, We've got another profit and loss statement, income statement, whatever you want to call it, for ABC Company. They are a middle market, smaller construction company. So as you can see here, revenue increased by 11%. So $1 million in this scenario. Op expenses increased by 33% right here, this guy. Um, Project management costs is something to look at here, as well as officers' salaries, as you could see, kind of similar to the last scenario. Office admin salaries increased as well. So overall, their net margin decreased by um, 41% year over year. And then, um, so yeah, but overall, I'd say overhead expansion might have gone just a little bit too fast. It might be best to scale profit before you scale expenses. So they possibly could be hiring too many people on too early. So that's another thing to keep in mind. And then marketing costs down here have increased as well. So it might be best to take a look at whether or not the marketing campaign is successful, if they're seeing success in that. Um, if costs have risen by 38%, but sales only increased by 11%, it might be best to look into that a little further. Um, so yeah, moving on to the next example. We've got our last profit and loss statement here. So this example, it's just current year revenues and expenses. Um, Looks like a strong gross margin, which is down here, 60%. Good cost control, as you could see. Their operating expenses are only 2.8 million. Their net margin is pretty healthy at 24%. Like we had said earlier, between 10 and 20% is kind of where you want to be. And this company here, there's enough room for hiring on a few individuals strategically, of course. You don't want to just hire on anyone just to hire them on. Um, so yeah, might be a good idea to, or I guess there's enough room, for not only hiring, but investments, expansion, as well as owner compensation. So that's this example. And lastly, our balance sheet here. This is a relatively basic, but also a healthy balance sheet. Lenders use some of these ratios down here to determine the capacity of to which they manage debt. and lower ratios indicate better financial performance and financial health. So our current ratio here is going to be your total current assets divided by total current liabilities. So 1.5 to 3 is considered pretty strong. Above 3 might be a little too strong, and to say the sense that the company might be hoarding cash and they could be investing that cash into some sort of investments, index funds, or some stuff like that, or even investing in more long-term assets for the financial health, the long-term financial health of the company. So moving back to the current ratio here, like we said, 1 to 3 would be kind of in that good range, but anything less than 1 would kind of indicate a little bit of risk and considered perhaps um, a liquidity issue. So liquidity is obviously deals with the amount of cash and liquid assets that you have on your balance sheet. So yeah, moving on to our next leverage ratio here. Um, Looks like 43 is our debt to assets ratio. So debt to assets is going to be total assets divided by total liabilities. So debt to assets kind of explains um, how they use debt strategically to grow without being over leveraged. So also what percentage of assets are financed by debt. So that's what debt to assets ratio means in simplified terms. Um, a less than 5 ratio would indicate more of a conservative approach, and to say the sense, um, and that the company is relying more on equity, which is safe, but it might not be, but it might suggest overutilized growth potential. And then lastly, the debt to equity ratio suggests the amount of debt that is financed by the amount of equity that is financed by debt, excuse me. So that ratio is going to be total liabilities divided by, your shareholders' equity or owners' equities for the smaller companies out there. So for this particular example or scenario, a high ratio is going to be above 2. So if our equity was much below the amount of liabilities that we had on the balance sheet, that would be high, and it would be suggest that the company's obviously highly reliant on debt. If it was a lower ratio, it would suggest, which would be kind of less than 0.5, it would suggest that the company had low debt and more equity. So yeah. Um, that is about all we had for today. Once again, here's how you can find us on social media. We do these Facebook Lives once a week. So yeah, be sure to tune in next week. You can find us on Facebook at Jake Gronowski CPA, as well as Instagram and LinkedIn. And just reach out if you'd like to book a discovery call and get a one-on-one with us. So yeah, I hope everyone has a great rest of their evening, and thanks for tuning in.